So when it comes to property investing, tax is really, really important. We don't touch the tax space, but we work with a lot of professionals that specialize in exactly that area. And today I've invited Danny Dinkha from STP Tax to talk about property investing and tax strategy. Danny, thanks for being here.
Great to be here.
How important is tax to the property investment process?
Extremely important.
Why?
There are various examples of this. To an investor, investing into, for example, property gives them a sense of creating wealth, providing future income to substitute on their retirement needs, but also an average client would like to minimize tax in the right way.
That's right. And there aren't too many ways which you can minimize tax, right? It really comes down to the importance of having a strategy that's compliant and a strategy that is effective.
Correct.
So what I usually tell people is what you earn is after tax.
Yes.
You know, what you keep is after tax. You might earn this big amount of money, but then you pay your taxes, and so what you're left with is really what you should focus on.
Excellent.
What sort of strategies are available for your average investor around tax?
Yeah, absolutely. I always explain the philosophy, and I say to my clients, why do you think we call it gross? You know, gross wages, gross salaries, and then nobody actually came up with an answer. And I said, because it's actually disgusting. When you see your figure before tax,
It's gross, yeah, that's right.
it's not actually what hits your account. And we know that clients, their disposable income is what really hits their account in order to maintain their living expenses, but also implement effective ways in terms of growing their wealth.
Yep.
Now, you're absolutely right. When it comes to individuals that are hardworking, paying excessive amount of tax with nil strategies is not a strategy for success. It's not a strategy to create wealth. And a main contributor of creating wealth is through property. So for example, in terms of an individual looking to invest in the property market, there are some significantly generous concessions.
So let's talk about them. Let's start with some examples. Negative gearing. We hear about it in the media, everybody talks about it. For those that don't know how it works, in a nutshell, how's negative gearing work?
Yeah, absolutely. So the way negative gearing actually works, the definition is whatever the expenditure or the cost of maintaining a particular investment property, if the cost exceeds the income that it receives, then the difference becomes negatively geared. And what negative gear is, it allows the investor to claim their marginal tax off that amount.
Okay. Does this apply to people that live in the house, or does this only apply to those that are renting out the property itself?
Yeah, great question. Negative gearing only is applicable to individuals who are investors. So not if you're living there, so that means it's your principal place of residence. Because in order to claim a deduction, in order for an expense to occur, they must attempt to earn an income, and that income becomes their rental.
So as long as there's an income producing activity,
Correct.
then there's an ability to claim the costs that come with deriving that income.
Absolutely.
One of the biggest costs, I think, that the tax office allows in Australia is depreciation. And that's one of the reasons why we stick to brand new, or we have a very strong preference to brand new. For somebody thinking of going out and investing in an old shack as opposed to something brand new, how important is depreciation?
Extremely important. Depreciation could mean the difference that the investor receives tax dollars back in their pocket. Without depreciation, that it might be actually positively geared. So they might have to pay tax on the amount.
How does depreciation work? Very, very simply.
Absolutely. So depreciation is broken up into two categories. First, you've got capital works, which is the depreciation based on the build. So if you look at a building, bricks, for example, that depreciates over time. So the definition of depreciation is the wear and tear of an asset over its life.
So even though the value of the asset is likely to rise, the tax office actually says that you can claim an expense on wear and tear. Is that right?
Absolutely. So that's the first part, is dealing with the actual build that depreciates over time. Secondly is what we call property plant equipment, which is in relation to the fixtures and fittings. So you look at, for example, whether a kitchen with bathrooms, if something is brand new, you fit in, but after the time you use it, it's going to wear and tear, and that's where depreciation comes together. So for brand new dwellings, the actual investor maximizes their depreciation because the build is brand new.
It's new. It's only going to get worse.
Exactly.
Which means that you have a whole chunk of potential expense coming.
Absolutely. And the build is depreciated over 40 years. So if it's a brand new property, then you are maximizing that life cycle of the depreciation.
When is the most depreciation realized? The most depreciation benefit realized? Is it equal over those 40 years, or is it more skewed towards the first 10 or 20 years?
Fantastic question. Generally, it's 10 to 20 years is the most effective. That's because property, your fixtures and fittings depreciate much more rapidly in the first 10 to 20 years.
Yep.
But when it comes to capital works, it's a flat rate over that 40-year period.
Okay. So it starts to get quite technical.
Absolutely. So there is various strategies which we accountants tend to implement. So when it comes to depreciation, there's a more aggressive type,
Yep.
Which depreciates a lot more in the earlier years and a lot less in the later years. Or there's depreciation where it's a flat line. So it's a more gradual, consistent approach.
So before we move on to the strategies, another area, debt. I say debt is fantastic if you have an effective strategy. And coming from a Mediterranean background, a lot of people come from a cultural background where debt is this bad thing. Don't have debt, it's bad for you, pay off all your debt. And I say that's very different to investing in the modern world and developed economies where debt is actually a strategy. Where does debt fit in from a tax perspective?
Yeah, absolutely. Debt gives you a lot of advantages when it comes to tax. And I do understand from that particular background is where we, the common mindset is, I would rather pay cash for it.
Yeah.
I don't want any debt.
Which is really dumb, right? From a tax perspective. Look, I say it's dumb, you might want to use a different word, but I say to people that's just really, really dumb because you're not thinking about the numbers from a tax perspective.
Absolutely. I mean, if you didn't have debt, you don't have anything to offset or minimize the level of income you receive. If I think about my self-employed clients,
Yep.
the clients who operate companies, the clients who are in partnerships, their goal is when they do effective strategies and they've acquired debt and they've increased their expenses in according with their expansion goals and objectives, they do get tax concessions because of that.
What about debt on your family home?
Yes.
Are there any incentives or concessions around that, or is this purely for investments?
Fantastic. Now, the reason with debt in respect to your own place of residence, the reason why I call it still a good debt is because if you ever do decide to sell, if it's been your principal place of residence for the entire period, there's no capital gains tax on the proceeds or the profits.
Yeah.
See, and that's a different case when it comes to investments, and that's why when we think tax strategies is not to buy and sell stock. It's to buy, maintain, grow your portfolio into particular later stages in your life. So if I was to say, in terms of that debt debate, I look back at my university days and I had HEX debt, right? And nobody likes HEX because you're coming out of uni as a fresh graduate with debt. However, it is a good investment.
It's an awesome,
If I didn't do that particular investment, I wouldn't be here at this particular point in time.
So that's a great example of an awesome debt deal where you can go and skill yourself up and get this huge cash flow benefit into the future, and you'll pay it off over the life of your working life.
Absolutely. And most of my clients, when I do see them year and year onwards, and when we talk about their properties and their valuation and how much that's got actually appreciated, when they turn around, they actually realize, well, Danny, if I actually didn't have this home or if I didn't actually have this investment, I'd never even come close to saving what it actually appreciated by.
And our tax system is designed in a way where if you're actually saving and earning interest, you're getting taxed on that, right? So it comes back to those tax strategies. Yes. Danny, let's finish off with strategy. For someone that's watching this that may have an accountant, that someone lodges their returns, hasn't really sat down and had to think about strategy, what do you offer? How do you work? And why do you think having that holistic conversation is important?
Absolutely. Look, from an accountant's perspective, accountants traditionally are viewed as number crunchers. You give them the figures, they don't really much interact with you, they pull out an end of result, and then you accept it and you move on. that's not value added. That's not value added. In my practice, what I focus on is I focus on my clients. So the data entry part, the compliance part, I mean, that should come automatically.
Anyone can do that now, right?
Absolutely.
You can log your own return, or you can just go to someone that just fills it out. That's not really an accountant relationship, I think.
Exactly, because what value does that add to the client?
Yeah.
Whereas the differentiated approach is we have to know our clients. I have to know each one of my clients' goals, their objectives, and where they want to head. Now, accountants definitely report on historical data, which means that numbers produced in the past, and we consolidate it, and then we report on it. But moving forward into the future, it's about what we can do for our clients going in from 5 years from now, 10 years from now, 20 years from now, providing them with the data, with the forecasts, in order for them to make informed decisions. And that's where the value-added services differentiate between traditional accountants and accountants who invest in their clients into the foreseeable term.
Now guys, I know Danny well. The reason why I invited Danny here to have this conversation is so you can get a little bit of a glimpse from a tax professional as to how important tax strategy is. Danny has also offered up his time for EPG clients. If you did want to have a chat, Danny, you'd be happy to have a consultation with our clients, give them a bit of peace in mind, tell them a little bit more about what you do.
Look, I absolutely would love to work with clients, in particular EPG clients, and I do encourage that when clients do make such big investment decisions, they have to consult with the experts
100%.
in order to make the decision that's right for them.
Thank you very much for your time.
Thank you, Pete.
Final comments for anybody watching this, thinking about getting in touch, or someone that might be scared to reveal or thinks of tax as this thing that's in the back of their mind that they don't want to address. Final comments to them.
Yeah, absolutely. Look, there's a lot of people out there who definitely fear tax, and the common consensus that I receive is I want to minimize tax, I want to minimize tax, and I want to minimize tax. But my question to everyone who's thinking along those lines is there has to be effective strategies being implemented. There has to be a plan, a high level of effort that has to go into it in order for the impact to be significant. And so to everyone is reach out to your experts, reach out to the individuals, to the organizations, to the professionals who make a difference. And if you don't get that, or if you're not satisfied, seek a second opinion, seek a third opinion. But until you feel confident that you've been equipped with everything you need to move forward in alignment with your goals and objectives, that's when you know that you've come to the right place.
As you can see, Danny is very passionate about tax. He's the man to speak to. Hopefully this has been of value to you. Thanks again.
Thank you, Pete.